Banking Secrets, written and published by Rich Audiobooks. When you deposit $1,000 0 cents in your bank account, you probably imagine that money sitting safely in a vault waiting for you to withdraw it. The reality is far more intriguing and potentially unsettling. Your bank only keeps a small fraction of your deposit on hand, typically around 10%, while lending out the rest to other customers. But here's where things get interesting. The bank doesn't just lend out your $900 0 cents once. They create new money in the process. Through a practice known as fractional reserve lending, banks have been granted the extraordinary power to multiply money. When they make a loan, they don't transfer existing money from one account to another. Instead, they create brand new money with a few keystrokes, effectively expanding the money supply. That $1,000 0 cents deposit can theoretically generate up to $10,000 0 cents in new money as it cycles through the banking system. Lesson 1. Fractional reserve lending creates money from thin air. This process has been fundamental to modern banking since its inception in medieval Europe. Goldsmiths noticed that depositors rarely claimed all their gold simultaneously, so they began issuing more paper receipts for gold than they actually held. These receipts circulated as currency, and modern banking was born. Today's digital banking system operates on the same principle, just with electronic entries instead of paper receipts. The implications of this system are profound. Banks aren't merely lending out other people's money, they're creating new money every time they make a loan. When you take out a mortgage, the bank doesn't transfer someone else's savings to you. They create new money by adding digits to your account, backed by nothing more than your promise to repay and the fractional reserves they maintain. This money creation process explains why banks are so profitable. They earn interest on money they create out of thin air, while only paying interest on the actual deposits they hold. The spread between these rates, combined with the multiplication of money through fractional reserve lending, generates substantial profits. Your $1,000 0 cents deposit might enable the bank to earn interest on several times that amount through successive rounds of lending. Critics argue this system gives banks too much power and creates inherent instability in the economy. If too many depositors demand their money simultaneously, a bank run, the fractional reserve system can collapse. This risk is why governments created deposit insurance and central banks as lenders of last resort. These safeguards protect depositors, but also enable banks to continue their money-creating activities with confidence. Understanding fractional reserve lending reveals why banks are so essential to the economy and why they're so carefully regulated. It's not just about storing money or facilitating transactions. Banks literally create the money supply that fuels economic growth. Every loan they make expands the money supply, and every loan repayment contracts it. This process gives banks enormous influence over economic activity and explains their central role in both booms and busts. The next time you make a deposit, remember that your money isn't just sitting idle in a vault. It's being used as the foundation for new money creation through the fractional reserve system. Your $1,000 0 cents deposit becomes part of a much larger web of credit and debt that powers the modern economy. The bank isn't just storing your money. They're using it as a launching pad for creating more. Lesson 2. Interest on your deposits funds their profits. When you deposit money in your bank account, you might feel satisfied knowing your money is safely stored while earning interest. However modest that interest rate may be, it's better than keeping cash under your mattress. Or is it? The reality of how banks use your deposit interest rates to generate massive profits is both fascinating and concerning. Banks operate on a fundamental principle. They pay you a minimal interest rate on your deposits while charging much higher rates to borrowers. This difference, known as the interest rate spread, or net interest margin, is one of the primary ways banks generate billions in profits annually. For example, while your savings account might earn 0.1% annual interest, the bank simultaneously lends that same money to other customers at 6%, 12%, or even higher rates. The history of deposit interest rates reveals a stark reality. In previous decades, savings accounts commonly offered 5% or higher interest rates, allowing depositors to maintain purchasing power against inflation. Today's rock-dollar rates aren't just a product of economic conditions. They represent a calculated strategy by banks to maximize their profit margins while providing just enough incentive to keep customers from withdrawing their funds. Consider this. When you deposit $10,000 0 cents In a typical savings account, earning 0.1% annual interest, you'll receive just $10.00 in interest for the entire year. Meanwhile, the bank can use your $10,000.00 to issue credit cards at 24% APR, personal loans at 12%, or mortgages at 6%. Through the magic of fractional reserve banking, they can actually lend several times your deposit amount, multiplying their earnings while paying you a fraction of a percent. International banking practices highlight how American depositors often receive particularly unfavorable rates. Many European and Asian banks offer significantly higher interest rates to depositors, sometimes 2–3% higher than their U.S. counterparts for similar accounts. This disparity exists largely because of different banking regulations and competitive environments, but it demonstrates that higher deposit rates are indeed possible while maintaining profitable operations. The digital banking revolution has introduced some competition, with online banks typically offering higher interest rates than traditional brick-and-mortar institutions. However, even these high-yield accounts usually offer rates well below the inflation rate, meaning your money loses purchasing power over time, while banks continue to profit from lending it out at much higher rates. Banks justify these low rates by citing operational costs, regulatory requirements, and the need to maintain profitability. Yet their financial statements tell a different story, one of record profits largely built on the spread between what they pay depositors and what they charge borrowers. The largest banks consistently report billions in quarterly profits, with net interest income often representing the largest portion of their revenue. Smart depositors can take steps to capture more value from their deposits. Rate shopping among different institutions, including online banks and credit unions, can lead to significantly better returns. Some accounts offer promotional rates or tiered interest structures that reward higher balances. Understanding these options helps depositors maximize their returns, though the rates will still pale in comparison to what banks earn by lending out those same deposits. The relationship between deposit interest rates and bank profits reveals a fundamental truth about modern banking. Your deposits are not just secure storage, they are the raw material banks use to generate substantial profits. While banks provide valuable services, understanding this dynamic helps depositors make more informed decisions about where and how to keep their money. Lesson 3. Fees on free accounts stack up. The banking industry has mastered the art of marketing free checking and savings accounts, but these offerings often come with strings attached that can quickly transform them into expensive financial products. Banks understand human psychology. We're drawn to anything labeled free and are less likely to scrutinize the fine print once we believe we're getting something for nothing. The reality is that these accounts operate on a complex web of fees that generate substantial revenue for banks. Monthly maintenance fees typically range from $5.00 to $25.00 and can be waived only if you maintain a minimum balance or meet specific requirements like direct deposit arrangements. This system ensures banks either collect fees directly or retain control of larger deposits they can use for lending and investments. Banks have developed numerous creative fee structures that catch customers off guard. Account holders often encounter fees for paper statements, teller assistance, wire transfers, foreign transactions, and even calling customer service. These charges might seem small individually, but banks rely on their cumulative effect across millions of customers. A $3.00 statement fee applied to just 100,000 accounts generates $300,000.00 monthly for the bank, and that's just one fee type. The ATM network presents another lucrative fee opportunity. While using your bank's ATMs might be free, out-of-network withdrawals often trigger two separate charges, one from your bank and another from the ATM operator. These fees have steadily increased over the years, with combined charges often exceeding $7.00 per person. Banks count on customer convenience taking precedence over fee avoidance, especially in moments of immediate cash need. Digital banking hasn't eliminated fee opportunities, it's created new ones. Some banks charge for external transfers, bill pay services, or expedited electronic payments. Even basic account features like mobile check deposit might come with limitations that, when exceeded, trigger additional fees. The digital age has simply shifted the fee structure rather than eliminating it. The most insidious aspect of account fees is their disproportionate impact on lower-income customers. Those who struggle to maintain minimum balances are more likely to incur monthly maintenance fees. They're also more vulnerable to overdraft fees and more likely to use out-of-network ATMs in their neighborhoods. This creates a cycle where those who can least afford bank fees end up paying the most for basic banking services. Banks also profit from the timing of transactions and fees. They often process larger transactions first, potentially triggering multiple overdraft fees on smaller subsequent transactions. A customer with $100.00 in their account might face 3 separate overdraft fees if a $101.00 charge processes before 3 $20.00 purchases, rather than just one fee if the sequence were reversed. Understanding these fee structures requires vigilance and careful reading of account agreements that often exceed 50 pages. Banks frequently modify these terms, sending notices that most customers never read. These changes might introduce new fees or alter the conditions for avoiding existing ones. The banking industry counts on this information overload to maintain their fee-based revenue streams while marketing only avoid averages to new customers. By recognizing these fee patterns and understanding how banks generate revenue from seemingly free accounts, consumers can make more informed choices about their banking relationships. Smart account management, strategic use of technology, and awareness of fee triggers can help minimize these charges, but it requires constant attention to an account's terms and usage patterns. Lesson 4. Loans earn them more than you. When you take out a loan from a bank, you're not just borrowing money, you're entering into a carefully calculated profit arrangement that heavily favors the lender. Banks have mastered the art of loan structuring to ensure they earn substantially more than the borrowers who use the money for their ventures or needs. Consider a typical $30,000 car loan at 6% interest over 5 years. While borrowers focus on the monthly payment of around $580, banks see a different picture. Over the life of the loan, they'll collect nearly $5,000 in interest payments, money created purely from the borrower's promise to pay. The bank's actual cost to provide this loan is minimal, especially considering they're often using other customers' deposits to fund it. The profit margins become even more striking when examining business loans. Banks typically charge higher interest rates for commercial lending, citing increased risk. However, they often require substantial collateral, personal guarantees, and maintain strict lending criteria that minimize their actual risk exposure. A business owner paying 12% interest on a $100,000 loan might generate over $30,000 in interest payments for the bank, while the business owner bears all the operational risk of putting that capital to work. Banks further enhance their loan profits through origination fees, processing charges, and prepayment penalties. These additional revenue streams are pure profit, requiring minimal extra work from the bank. An origination fee of 1% on a $200,000 mortgage instantly generates $2,000 for the bank before a single interest payment is made. If the borrower tries to pay off the loan early to save on interest, prepayment penalties ensure the bank still captures its expected profit. The mathematics of loan profitability extends beyond simple interest calculations. Banks employ sophisticated algorithms to determine risk-adjusted returns, allowing them to price loans at levels that guarantee substantial profits, even accounting for default rates. They can afford to lose money on a small percentage of loans because the interest and fees from performing loans more than cover these losses. Time works invariably in the bank's favor when it comes to lending. While borrowers see their purchasing power diminished by inflation over the loan term, banks structure payments so they receive the most interest during the early years of the loan. This front-loading of interest ensures profitability, even if the loan is paid off ahead of schedule. A borrower making extra payments on a 30-year mortgage might be surprised to learn how little these additional payments reduce the total interest owed. The digital age has made loan processing more efficient than ever, yet banks continue to charge the same or higher interest rates. Online loan applications, automated underwriting, and electronic payment processing have dramatically reduced the cost of loan servicing. But these savings rarely translate to lower borrowing costs for customers. Instead, they contribute directly to the bank's bottom line. Perhaps most importantly, banks hold a crucial advantage in lending. They can create loan money through fractional reserve banking, while borrowers must work to earn every dollar they repay. This fundamental asymmetry means that banks profit from both the creation and repayment of loans, while borrowers shoulder the burden of generating real economic value to meet their obligation. Understanding this dynamic reveals why loans consistently generate more wealth for banks than for the customers who borrow from them. Lesson 5. Credit cards trap you in high interest. Credit cards represent one of the banking industry's most profitable ventures, designed with sophisticated psychological triggers that encourage spending and debt accumulation. Banks understand human behavior intimately: our desire for instant gratification, our optimism about future ability to pay, and our tendency to underestimate the impact of compound interest. This knowledge shapes their credit card products to maximize profitability while presenting an illusion of convenience and reward. The foundation of credit card profitability lies in their extraordinarily high interest rates, often ranging from 15% to 29% APR, even when the federal funds rate hovers near zero. Banks justify these rates by citing risk management, but the reality is that credit card divisions generate billions in pure profit annually. The interest rates are particularly insidious because they compound daily, meaning each day's interest charges become part of the next day's balance, creating an exponential growth in debt. Credit card companies deliberately set minimum payments low, typically around 2–3% of the balance. This seemingly helpful feature actually serves to extend debt periods and maximize interest collection. A $5,000 0-cents balance at 19.99% APR, paying only the minimum, could take over 15 years to repay and cost more than $7,000 0 cents in interest alone. Banks count on consumers focusing on the manageable minimum payment rather than the total cost of carrying the debt. The rewards programs that seem to offer free perks are carefully calculated to encourage increased spending and card use. Cashback rewards of 5% are easily offset by the interchange fees charged to merchants, which are built into retail prices paid by all consumers. Points, miles, and bonus categories create a gaming mentality that often leads to unnecessary purchases or carrying balances that negate any rewards value. Banks have found that rewards program members typically spend more and maintain higher balances than non-rewards cardholders. Late payment penalties and over-limit fees add another layer of profitability. While regulations have curtailed some aggressive fee practices, banks still generate significant revenue from these charges. They strategically set payment due dates and processing times to maximize the likelihood of late payments. Some banks even use algorithms to predict which customers are most likely to incur fees and target them with credit line increases or promotional offers. The entire credit card system operates on a complex web of psychological manipulation. Marketing materials emphasize freedom, status, and immediate gratification, while minimizing the long-term financial implications. Banks leverage behavioral economics principles, knowing that consumers tend to overvalue present benefits and undervalue future costs. They promote the cards as financial tools while designing them as debt traps. Usual technology has only enhanced banks' ability to profit from credit cards. Mobile apps and online portals make spending easier than ever, while automated payment systems can mask the real impact of purchases on financial health. Push notifications for special offers and spending opportunities create constant temptation, while the disconnect between digital transactions and physical money makes overspending more likely. Banks have mastered the art of making credit cards feel essential to modern life, while obscuring their role as powerful profit engines. They position cards as status symbols, emergency backstops, and financial management tools, all while collecting data on spending patterns to refine their marketing and pricing strategies. The true genius of credit cards lies in their ability to make consumers feel empowered while systematically separating them from their money through interest charges and. Lesson 6. Your money works for them 24/7. Your bank account balance might appear static on your smartphone screen, but behind the scenes your money never sleeps. Banks operate in a complex, interconnected global system that enables them to put your deposits to work around the clock, generating continuous revenue streams that most customers never see or understand. When you deposit money in your account, it immediately becomes part of the bank's working capital. During regular business hours, these funds support various lending activities, from personal loans to business credit lines. But the real magic happens after hours in the sophisticated world of overnight lending. Banks lend excess deposits to other financial institutions through the interbank market, earning interest even during the midnight hours. This practice, known as the federal funds market in the United States, allows banks to maintain regulatory requirements while maximizing the productive use of every dollar in their possession. The global nature of modern banking adds another dimension to this perpetual money machine. As markets close in New York, trading begins in Tokyo, followed by Hong Kong, then London, and back to New York in an endless cycle. Your deposit might help finance an Australian business expansion while you sleep, then fund European trade operations during your morning coffee, and support American real estate developments in the afternoon. This continuous movement of capital across time zones ensures that banks can generate returns virtually every moment of every day. Investment banking operations, often housed within the same financial institutions that hold your deposits, take advantage of this 24/7 money flow to engage in sophisticated trading strategies. While regulatory firewalls supposedly separate retail banking from investment activities, banks have mastered the art of using their deposit base as a stable foundation for more aggressive profit-seeking ventures. Your seemingly modest savings account helps provide the liquidity and stability that enables banks to participate in everything from currency trading to corporate mergers. The velocity of money, how quickly a dollar changes hands, amplifies these effects. Through modern financial technology, banks can use the same dollar multiple times within a single day, earning fractional returns on each transaction. Think of it as a financial game of hot potato, where your money might facilitate dozens of transactions before returning to its starting point, with the bank skimming a small profit from each exchange. These minimal margins, multiplied across millions of transactions and accounts, generate substantial revenue streams that flow continuously into bank coffers. Digital banking has supercharged this system by eliminating many physical constraints on money movement. Gone are the days when paper checks had to be physically transported and cleared. Today, electronic fund transfers, digital payment systems, and automated clearinghouses move money at the speed of light. This efficiency allows banks to maximize the productive use of deposits, ensuring that idle funds are rare and profit opportunities are seized instantly across the globe. The banking industry's ability to leverage your money around the clock represents one of its most powerful advantages. While you earn minimal interest on your deposits, banks deploy sophisticated strategies to ensure your funds generate maximum returns for their shareholders. They've created a perpetual motion machine of profit, using the stability of retail deposits to fuel an endless cycle of lending, trading, and financial engineering. Understanding this reality helps explain why banking remains one of the most profitable industries globally, despite offering historically low returns to ordinary depositors. Lesson 7. Mortgages turn homes into lifetime revenue. The modern mortgage system represents one of banking's most ingenious and profitable inventions. When you sign a mortgage agreement, you're not just borrowing money to buy a house, you're entering into a carefully engineered financial arrangement designed to generate maximum revenue for the bank over decades. At the heart of this system lies the amortization schedule, a sophisticated mathematical formula that front-loads interest payments in the early years of your mortgage. During the first several years, the vast majority of your monthly payment goes toward interest rather than principal. This means that even after making payments for 5 years on a 30-year mortgage, you've barely made a dent in the actual loan amount. The bank collects thousands in interest before you build any meaningful equity in your home. Banks have further enhanced their mortgage profits through the secondary mortgage market. After originating your loan and collecting hefty fees, many banks sell your mortgage to government-promising enterprises like Fannie Mae or Freddie Mac. This allows them to immediately recoup their capital while maintaining servicing rights that generate ongoing fees. They can then use the freed-up capital to issue more mortgages, creating a perpetual cycle of profit generation. The refinancing process adds another layer of revenue potential. While refinancing can sometimes benefit homeowners through lower interest rates, banks actively promote refinancing because it generates a new round of origination fees and resets the amortization schedule. Each time you refinance, you restart the clock on interest-heavy payments. Banks often market refinancing as a way to lower monthly payments, but they rarely emphasize how extending your loan term means paying significantly more in total interest over time. Property taxes and insurance requirements create additional profit centers through escrow accounts. Banks collect these funds monthly, but only disperse them annually or semi-annually. During this time, they can invest and earn returns on your money while providing no interest to you. Moreover, they charge fees for managing these escrow accounts, turning a basic service into another revenue stream. The real estate boom-bust cycle works in banks' favor regardless of market conditions. During booming markets, they profit from increased lending volume and higher home values. During downturns, they benefit from foreclosure processes that allow them to reclaim properties, often after collecting years of interest payments, which they can then resell when market conditions improve. Perhaps most importantly, mortgages create customer loyalty through necessity. Once you have a mortgage with a bank, you're more likely to use their other services, from checking accounts to credit cards. This cross-selling opportunity transforms a mortgage customer into a multi-productive revenue source that can span generations. Banks have also mastered the art of making mortgage products increasingly complex. Adjustable-rate mortgages, balloon payments, and interest-only loans create opportunities for higher interest rates and fees while making it harder for consumers to understand the true costs. These sophisticated products often benefit the bank more than the borrower, yet they're marketed as innovative solutions for home ownership. When you calculate the actual cost of a home purchased with a traditional 30-year mortgage, the numbers are staggering. A $300,000 0-cents home financed at 6% interest will cost over $647,000. 0 cents over the life of the loan, more than double the purchase price. This exemplifies how banks transform the basic human need for shelter into a multi-decade revenue engine that significantly multiplies their initial investment while keeping borrowers tethered to their institution through one of life's most significant financial commitments. Lesson 8. Overdrafts are cash cows. For banks, overdraft fees represent one of their most lucrative revenue streams, generating billions in profits annually from customers' financial missteps. What began as a courtesy service to help customers avoid the embarrassment of bounced checks has evolved into a sophisticated profit center that often targets those least able to afford additional charges. When a customer overdraws their account even by a few dollars, banks typically charge fees ranging from $25, 0 cents, to $35, 0 cents per transaction. These fees apply regardless of the transaction amount, meaning a $5 0 cents coffee purchase that overdraws an account could trigger a $35 0 cents fee, an effective interest rate of 700%. Banks have refined their processing systems to maximize these fees, often processing larger transactions first, which can lead to multiple overdraft charges from smaller subsequent transactions that might otherwise have cleared. The banking industry has mastered the art of timing these charges for maximum effect. Many institutions process debits before credits during nightly processing, even when credits arrive first during the business day. This practice increases the likelihood of accounts falling into negative territory, triggering overdraft fees. Some banks even charge extended overdraft fees when accounts remain negative for several days, compounding the financial burden on struggling customers. The demographics most affected by overdraft fees reveal the predatory nature of this practice. Studies show that just 9% of account holders pay 84% of all overdraft fees. These customers tend to be lower-income people living paycheck to paycheck, making overdraft fees a regressive penalty that disproportionately impacts those with the least financial cushion. Young adults and minority communities are particularly vulnerable to these charges, often lacking the financial education or resources to avoid them. Banks defend overdraft programs as a valuable service that helps customers avoid declined transactions and return check fees. However, the revenue generated from these fees suggests a different motivation. In many cases, the total overdraft fees charged can exceed the amount of credit extended, creating a cycle of debt that benefits the bank while pushing customers further into financial distress. Digital banking has introduced new twists to overdraft practices. While some fintech companies advertise no overdraft policies as a selling point, traditional banks have adapted by offering overdraft protection services that link checking accounts to savings accounts or credit cards. These services often come with their own transfer fees, creating yet another revenue stream from customers attempting to avoid standard overdraft charges. The regulatory environment surrounding overdraft fees continues to evolve, with some banks voluntarily reducing or eliminating these charges in response to public pressure and competition. However, many institutions have simply shifted their fee structures or introduced new charges to maintain their revenue streams. Some banks now offer grace periods or minimum balance thresholds before charging overdraft fees, but these features often come with monthly maintenance fees or other requirements that can be equally costly for customers. Understanding the mechanics of overdraft fees reveals the sophisticated ways banks transform customer financial difficulties into profitable opportunities. While overdraft protection can provide a valuable safety net in genuine emergencies, the fee structure and processing practices demonstrate how banks have transformed this service into a reliable source of income. As customers become more aware of these practices, they can make informed decisions about their banking relationships and take steps to avoid falling into the overdraft trap that banks have so carefully designed. Lesson 9. Compound interest favors the lender. Compound interest has been called the eighth wonder of the world, but what most people don't realize is that this mathematical miracle overwhelmingly benefits banks and lenders rather than average savers. The basic principle seems simple: interest earned on previously accumulated interest. Yet this powerful force creates an exponential growth curve that dramatically favors those who lend money over those who borrow. Banks structure their lending products to maximize the effect of compound interest working in their favor. When you take out a loan, interest compounds against you, often daily or monthly, creating an accelerating debt burden that can be difficult to escape. Meanwhile, the interest rates banks offer on savings accounts compound much less frequently and at drastically lower rates, creating an intentional imbalance that drives their profits higher. This disparity becomes crystal clear when examining credit card debt. A $5,000 0-cent credit card balance at 18% APR compounds daily, generating additional interest charges on previously accrued interest. Without making any new purchases, that balance would grow to over $9,000 0 cents in just 5 years through compound interest alone. Yet when you keep $5,000 0 cents in a savings account earning 0.5% APR compounded monthly, you'll earn just $126 0 cents in interest over those same 5 years. The banking industry has mastered the art of using compound interest against consumers while minimizing its benefits to savers. They carefully calibrate interest rates, compounding frequencies, and payment structures to extract maximum value from borrowers. Even small differences in how often interest compounds can lead to significantly higher costs over time. Daily compounding on loans versus monthly or quarterly compounding on savings accounts may seem like a minor detail, but it represents billions in additional revenue for banks. This mathematical advantage extends beyond consumer lending into mortgages, business loans, and other banking products. The longer the loan term, the more dramatically compound interest works in the bank's favor. A 30-year mortgage allows compound interest to multiply the actual cost of a home several times over. While borrowers do build equity over time, the front-loaded interest structure ensures banks capture the majority of the compound interest benefit. Understanding how banks leverage compound interest reveals why they push products like home equity lines of credit, credit cards with high limits, and long-term loans. Each represents an opportunity to set compound interest working against the borrower. Even seemingly helpful features like minimum payments are designed to extend loan periods and maximize the compounding effect. The digital age has made it easier than ever for banks to calculate and apply compound interest with precision. Modern banking systems can compound interest continuously, tracking accumulated interest down to the penny and adding it to principal balances in real time. This technological capability allows banks to optimize their interest calculations for maximum profit while keeping the complex mathematics largely hidden from consumers. Banks also benefit from compound interest through their investment activities. While paying minimal interest on deposits, they invest those funds in vehicles that generate compound returns at much higher rates. The spread between what they pay depositors and what they earn through compound interest on investments represents another major profit center. Over time, this compounds into enormous wealth accumulation for the banking industry, while individual savers see minimal benefit from the same mathematical principle. The compound interest advantage helps explain why banks remain consistently profitable even during economic downturns. As long as they maintain their role as primary lenders in the economy, compound interest works tirelessly in their favor, multiplying their earnings while simultaneously increasing the real cost of borrowing for consumers. This mathematical reality underlies much of modern banking's profitability and helps explain why financial institutions focus so heavily on lending activities. Lesson 10. They invest while you save. While average customers deposit their money into low-yield savings accounts, Banks leverage these same funds for sophisticated investment strategies that generate substantial returns. This fundamental disparity in how banks utilize customer deposits versus how customers are permitted to grow their money represents one of banking's most profitable disparities. Banks employ teams of financial experts, analysts, and traders who work diligently to identify lucrative investment opportunities across global markets. These professionals use advanced trading algorithms, market analysis tools, and institutional knowledge to maximize returns on the pool of deposited funds. Your savings account earning 0.1% annual interest might simultaneously be funding complex investment portfolios yielding 10% or more for the bank. The investment activities of banks extend far beyond simple market trading. They engage in corporate lending, venture capital, private equity, and real estate development, all areas typically inaccessible to regular retail banking customers. These investment ventures often yield significantly higher returns than what's available to individual investors, creating a two-tiered system where banks profit from opportunities their own customers cannot access. Banks also benefit from economies of scale in their investment activities. While individual investors face higher transaction costs and limited access to certain investment vehicles, banks can participate in institutional-level investments with preferential terms and reduced fees. They can spread risk across massive portfolios, access exclusive investment opportunities, and negotiate better terms than any individual investor could achieve. The timing advantage banks possess in the investment world is equally significant. They can react to market changes instantly, deploying capital across different asset classes and geographical regions as opportunities arise. Meanwhile, their customers' savings remain relatively static, earning minimal returns while the bank's investment arm captures market gains. This dynamic allows banks to profit from market volatility while their customers' returns remain flat or decline with inflation. Bank investments also benefit from privileged information flows and market insights that aren't available to regular savers. Their position in the financial system gives them early awareness of market trends, corporate activities, and economic shifts. This informational advantage, combined with their sophisticated trading capabilities, allows them to capitalize on market movements before the general public even becomes aware of them. The regulatory environment further amplifies this disparity. While banks maintain certain reserves against deposits, they have considerable flexibility in how they invest the remainder. They can engage in complex financial instruments, derivatives trading, and international investments that would be either too risky or simply impossible for individual investors to access. This regulatory framework essentially creates a protected space for banks to pursue higher-yielding investments while limiting their customers to basic savings products. Most customers remain unaware of how their deposits fuel this sophisticated investment machine. The bank's marketing focuses on the safety and security of savings accounts, while their investment activities operate behind the scenes, generating substantial profits from the same pool of money. This information asymmetry helps maintain the status quo, where depositors accept minimal returns while banks leverage their funds for significantly higher yield. The compounding effect of this investment advantage becomes apparent over time. While a customer's savings might barely keep pace with inflation, the bank's investment returns accumulate and multiply, building substantial wealth from the same initial capital. This wealth-building disparity represents one of the fundamental ways banks transform customer deposits into institutional profit centers, perpetuating the cycle of financial inequality between financial institutions and their depositors. Lesson 11. Banking products are disguised profit centers. The modern banking landscape is filled with an ever-expanding array of financial products, each marketed as essential tools for your financial well-being. From specialty savings accounts to investment vehicles, insurance products to wealth management services, banks have transformed from simple deposit institutions into financial supermarkets. However, these products often serve as sophisticated profit centers carefully designed to extract maximum value from your money. Take the popular money market account as an example. Banks promote these accounts as premium products offering higher interest rates than traditional savings accounts. Yet the difference in interest rates is often minimal, while banks use your larger deposits in these accounts to fund more profitable lending activities. The tiered interest rate structure typically requires substantial minimum balances, ensuring the bank maintains access to larger pools of investable funds. Certificate of deposit, CD, products represent another clever profit mechanism. While they do offer slightly higher interest rates than standard accounts, banks use the locked-in term to their advantage. Your money becomes a guaranteed source of lending capital for the duration of the CD term. When interest rates rise, you're stuck at the lower rate, while the bank can lend your money out at higher current rates. The early withdrawal penalties ensure they maintain control of your funds, or profit even more if you need to access your money prematurely. Investment products sold through bank channels often carry hidden fee structures that can significantly erode returns. Load fees, management fees, transaction costs, and administrative charges create multiple revenue streams for the bank, while the customer bears all the investment risk. Many customers trust their bank's investment recommendations without realizing that the bank often promotes proprietary products or receives commissions for selling specific funds. Banking packages that bundle multiple services together serve as particularly effective profit centers. By combining checking accounts, credit cards, investment services, and insurance products, banks create the illusion of value through relationship pricing. However, these packages often lock customers into higher-cost services they may not need, while making it more difficult to switch banks or shop for better deals on individual products. The rise of digital banking has introduced a new generation of profit-generating products. Mobile payment services, peer-to-peer transfer apps, and digital wallets all generate transaction fees and provide banks with valuable data about customer spending habits. This information is then used to target customers with additional products and services, creating a self-perpetuating cycle of profit opportunities. Insurance products sold through banking channels represent another significant profit center. Banks earn substantial commissions on these sales while positioning themselves as trusted advisors. Whether it's life insurance, property insurance, or specialized coverage, the bank profits not just from the initial sale, but often from ongoing administration fees and renewal commissions. Wealth management services marketed to affluent customers appear exclusive and personalized, but frequently direct clients into fee-heavy investment products that primarily benefit the bank. The personalized attention often translates into aggressive cross-selling of additional banking products and services. Private banking divisions excel at creating an aura of exclusivity, while essentially offering standard banking products with premium branding and higher fees. Student banking products deserve special mention as they target young customers at the beginning of their financial lives. These packages often appear tailored to student needs but are designed to establish long-term banking relationships that will generate profits for decades to come. From student loans to specialized checking accounts, these products create early brand loyalty while introducing young customers to fee-based banking services. The sophistication of modern banking products makes it increasingly difficult for customers to understand the true costs and benefits of their financial choices. What appears as convenience or special treatment is frequently a carefully constructed profit mechanism designed to maximize the bank's return on your money. Understanding this reality is essential for making informed decisions about which banking products truly serve your interests, rather than primarily benefiting the bank's bottom line. Lesson 12. Their risk is backed by your trust. The modern banking system operates on an extraordinary foundation of trust. Your trust. When you deposit your hard-earned money into a bank account, you're placing faith in an institution to safeguard your financial future. But this trust relationship is inherently imbalanced, as banks leverage your faith in them to take calculated risks with your money while protecting themselves from the consequences of those risks. Banks have masterfully created a perception of absolute security through various means, including federal deposit insurance, impressive building facades, and sophisticated marketing. This carefully crafted image of stability allows them to engage in increasingly complex financial activities that extend far beyond simple deposit taking and lending. Your trust enables them to participate in derivatives trading, securities speculation, and other high-risk ventures that can generate substantial profits or devastating losses. The 2008 financial crisis revealed how banks had weaponized public trust to engage in questionable practices, knowing they were considered too big to fail. When their risky bets on subprime mortgages and complex financial instruments imploded, it wasn't the banks who paid the ultimate price, it was the taxpayers who funded their bailouts. This demonstrated the fundamental asymmetry in the banking relationship. Profits are privatized, but losses are socialized. What many depositors don't realize is that their money isn't just sitting safely in a vault, it's being used as collateral for various banking activities. Through the magic of fractional reserve banking, Your $10,000 in Zohodofer might support $100,000, 0 cents or more, in loans and investments. The bank's ability to multiply money in this way depends entirely on depositors not withdrawing their funds en masse, a confidence game that relies on your continued trust. The Federal Deposit Insurance System, while providing necessary protection for depositors, has inadvertently enabled banks to take greater risks. Knowing that customer deposits are guaranteed up to $250,000, 0 cents, banks can pursue aggressive investment strategies without fear of triggering a bank run. This government backing essentially provides banks with a free insurance policy funded by taxpayers, while they retain all the upside potential from their risk-taking activities. Behind the scenes, banks employ sophisticated risk management systems and complex financial models to calculate exactly how much risk they can take with your money while maintaining the appearance of stability. They carefully balance their portfolio of risks, knowing that as long as they stay within certain regulatory boundaries, they can continue to exploit the trust-based system for maximum profit. The digital age has introduced new dimensions to this trust relationship. Online banking, mobile payments, and electronic transfers have made the banking system more convenient, but also more abstract. When your money exists primarily as numbers on a screen, it becomes easier for banks to use it in ways you might not fully understand or approve of. Global financial networks have further complicated the picture, as your local bank's risks may be interconnected with institutions and markets worldwide. A financial crisis in one country can ripple through the banking system, affecting depositors thousands of miles away. Yet banks continue to assure customers that their money is safe, even as they participate in this increasingly complex and interconnected financial web. Modern banking has evolved into a sophisticated system where your trust is not just an emotional factor, it's a quantifiable asset that banks can leverage. They understand that as long as depositors maintain confidence in the system, they can continue to use your money as the foundation for their profit-generating activities. This arrangement has proven incredibly lucrative for banks, while depositors receive minimal returns and bear the indirect costs of systemic financial risk. The relationship between banks and their customers remains fundamentally unchanged. Your trust enables their risk-taking, while their profits depend on your continued faith in the system. Understanding this dynamic is crucial for anyone who wants to make informed decisions about their money and their relationship with financial institutions.